Imagine never again paying federal income taxes, never again paying federal payroll taxes, never again investing based on federal tax consequences, never again paying federal gift taxes, never again worry about estate planning for federal tax purposes. Imagine never again collecting and storing sales or other bill receipts for tax purposes, never again filing an individual federal income tax return, never again paying someone to do your taxes, never again fearing your government because you do not understand your tax obligations. Imagine paying your federal taxes as a private individual to be as simple and voluntary as 1. Purchasing any new product or service. 2. Voluntarily registering each year the number of people in your family and their social security numbers to obtain a monthly tax rebate. How is that possible? The fair tax. The fair tax will replace all income taxes, alternative minimum taxes, payroll taxes, self-employment taxes, capital gains taxes, gift taxes, estate taxes, and corporate taxes with a single national sales tax. The fair tax rate will be 23% inclusive, 30% exclusive. Will be assessed on new and previously untaxed used products and all services. Will not be assessed on investment items and properties held for appreciation or income. Untaxes the basic necessities of life for all legal residents through a tax prebate mechanism. Is not assessed on business-to-business sales or products for export. The fair tax will reduce federal embedded taxes with the potential to lower products and services, provides businesses with applicable credits and refunds, administrative credits, transitional inventory credit, business and mixed-use conversion credits, intermediate and export sales credits, bad debit credit, insurance proceeds credit, and refund of overpayment. The fair tax is the result of years of research and study, is based on what the people and businesses want in a tax system, is supported by leading university economists including Nobel laureate Vernon L. Smith, meets the original Constitution intent for a federal tax and collection system, meets all 7 principles for an effective and efficient tax system. Simple, fair, neutral, visible, stable, efficient, and fosters economic growth. In the cost of every product and service purchased by consumers are elements of taxation imposed upon the producer and or service provider that are passed along to the consumer. The inclusive amount, typically referred to as embedded taxes, can vary considerably based upon the accumulation of such taxes and tax compliance costs throughout each stage of the production process for products or in the delivery of services. The embedded federal taxes can include hidden withholding taxes, both income and payroll, corporate taxes, and tax compliance costs. Tax compliance costs can take on many forms that may include paying for accountants, covering IRS-imposed penalties and interest, and business opportunity losses for greater productivity that occur as a result of consequential tax avoidance. These costs are in addition to any inclusive federal tariff, duty, impost, or excise tax levied on the product or parts thereof in the assembly of the final product. In the cost of every product and service purchased by consumers are elements of taxation imposed upon the producer and or service provider that are passed along to the consumer. The inclusive amount, typically referred to as embedded taxes, can vary considerably based upon the accumulation of such taxes and tax compliance costs throughout each stage of the production process for products or in the delivery of services. The embedded federal taxes can include hidden withholding taxes, both income and payroll, corporate taxes, and tax compliance costs. Tax compliance costs can take on many forms that may include paying for accountants, covering IRS-imposed penalties and interest, and business opportunity losses for greater productivity that occur as a result of consequential tax avoidance. These costs are in addition to any inclusive federal tariff, duty, impost, or excise tax levied on the product or parts thereof in the assembly of the final product. The penalties of the IRC. You are penalized because you cannot reasonably comprehend the code to which you are subject. You are penalized because you have to pay your taxes. A sad irony on the American taxpayer. You are penalized when you inadvertently overpay your taxes and it is not caught in subsequent audits. You are penalized when you underpay your taxes and it is caught in an IRS audit. As can be taken from the previous slides, the current system of income and payroll taxing can impose severe burdens and thus severe penalties on the American taxpayer. Because the system is beyond the reasonable comprehension of those to whom it is directed, it can be assumed to be an absolute penalty system in that you never know if you fully complied with the system or that you penalized yourself in attempting to comply. You are penalized because you have to pay your taxes. A sad irony on Americans. You are penalized when you inadvertently overpay your taxes and it's not caught in audit. In other words, you penalize yourself accidentally, or you did not understand the IRC, or you chose to take deductions because you felt intimidated by the IRS backlash if you made a mistake. You are penalized when you underpay your taxes and it's caught in audit. In this case, you owe the underpayment, plus interest, and the possibility of a penalty. You are penalized by investment loss due to withheld taxation on the first dollar earned. You are penalized by a system that facilitates double plus taxation, partly as a result of hidden cost and embedded taxes. You are penalized as an honest taxpayer when the deficit increases because of dishonest taxpayers. You are penalized by the regressive payroll tax system if you make less than the Social Security gap. Unlike the early days of income taxing when you paid by March 1st of the next year a lump sum for the previous year taxes, withholding today places a huge penalty on American investments by adding a loss amounting to more than $24 billion a year. This is because you are taxed on the first dollar earned and do not get to enjoy the benefit that dollar may contribute to your savings and investments growth. You are penalized by a system that facilitates double plus taxation as a result of hidden cost and embedded taxes. In fact, you pay taxes on the payroll taxes you pay since they are not deducted from the taxable income amounts upon which you are assessed income taxes. You are penalized as an honest taxpayer when the deficit increases because of dishonest taxpayers. You are penalized by the regressive payroll tax system if you make less than the Social Security gap. Your freedoms are penalized as the IRS is the United States government's most legally invasive agency delving into the personal lives of every legal wage-earning American. Failure to comply with a code that you and no one else understands can cost you nearly all that you own financially and materially, or you may share your retained assets with a tax attorney in an attempt to preserve them from the IRS. Is there a better way? Yes, there is. Let us now turn our attention to a better means of taxation where all of these penalties and other such unnecessary and oppressive burdens should not occur. Goals for a new tax system. First, the new tax system must collect revenues no less than those collected through the existing system. In other words, be revenue neutral. It must be simple to understand and transparent in all aspects of application. The system should remain progressive and untax the basic necessities of life for every income earner. The process of collecting the revenues must be cost-effective and efficient for all parties. No pain to pay your taxes. It must be considerably less intrusive, abusive, coercive, and corrosive than that imposed by the current IRC and IRS. And last, let's make it voluntary. Businesses and nonprofit exemptions. Under the fair tax, there will be no tax on goods or services that are sold on a business-to-business basis for resale, to produce taxable products or services, or for other bona fide business purposes. This will eliminate the cascading of embedded taxes that occurs in the production of products today. The fair tax will not be imposed on dues, contributions, and similar payments to qualified nonprofit organizations. Qualifying nonprofit organizations will be issued qualification certificates by the state administering authorities, which the organizations may use to make tax-exempt purchases of taxable products and services, the same as authorized for business-to-business and export sales. If the nonprofit provides a taxable product or service in connection with contributions, dues, or similar payments, then such products or services shall be treated as taxable, and taxes will be due at their fair market value of such products or services. All the foregoing with respect to nonprofit organizations is very similar to the current code requirements for both organizational qualification and tax exemptions. The tax rebate. There is an ideology held by many citizens in this country that the taxing of food, housing, and health care, which are the basic necessities for life, should not be taxed. However, what is food to one person may not be considered food by another. Housing or medicine to one person may not be considered housing and medicine to another. So, to avoid the potential conflicts of interpretation as to what is or is not a basic necessity, and to stay away from again getting into special exemptions and deductions on these items as exist under the current IRC, a clear delineation was determined, and means of untaxing these items has been proposed through a tax rebate mechanism, also called a prebate. It's called a prebate because it will be issued the first of each month as a before-the-fact payment, rather than an after-the-fact payment, as is done with refunds under the existing IRC. You get the tax return before you actually spend the money. The prebate will be issued to legal individuals and families who have registered individually or as a family with their state administering authority. Registration will be done annually and must include the name of all the eligible family members and their Social Security card numbers. This means that those in the U.S. illegally and having previously escaped paying their full share, of the American tax burden will pay their share under the fair tax, but not be eligible for the prebate. 2009 Fair Tax Rebate Schedule. This is the 2009 Fair Tax Rebate Schedule from which the rebate is determined. Note that unlike DHHS poverty schedule for two people, this schedule eliminates the marriage penalty that exists in the poverty schedule when the number advances from 1 to 2 people. As an example, we will look at a family of 4, dad, mom, and 2 kids, to see how the prebate program works. The annual allowances for a family of 4 using the 2-parent plus 2 row is $29,140. The inclusive federal tax that would have been assessed on this amount of goods and services at 23% would be $6,702, or $29,140 multiplied by 23 cents. This is the annual prebate amount, which is then divided by 12 to get the monthly prebate amount, which in this case is $559. This means that a family of 4 who has registered all the family names and Social Security numbers with the administering authority will receive $559 at the beginning of every month throughout the year. The great thing about this, too, is that it does not matter if they spent or even made $29,140 or $10 million. Every family of 4 gets the same amount. No class discrimination. Effective tax rate for income tax versus fair tax. Now, suppose there were 50,000 widgets available at the widget store that cost $1 under the current income tax. With the after-tax income, or take-home pay, the taxpayer could buy 39,831 widgets at $1 each. Now, we will not consider the state and lower level effect of taxing in this example, though it works the same for both systems of tax collection. The effect of the income and payroll taxes in this case is the effective tax rate of 20.3%. This rate is determined by dividing the amount of widgets that could be bought with the after-tax pay, or 39,831, by the total available amount, 50,000, thus 39,831 over 50,000, and then subtracting that product from 100%, or 100 minus 79.7 equals 20.3. This result is an effective tax rate of 20.3%. In other words, the taxpayer sacrifices 20.3% of all the widgets he could have bought had he not had any taxes to pay with his $50,000 salary. So he leaves $10,169 for the government and takes home 39,381 widgets with his net income. Now, let us turn to the fair tax. Under the fair tax, the taxpayer keeps all his salary and he gets an additional individual prebate of $2,496 for the year 2009. This means that under the fair tax, the individual has a total of $52,496 available to buy widgets. But the widgets have now risen to a gross price of $1.30 due to the 23% inclusive, 30% exclusive national sales tax, and again, we are assuming the worst possible case. However, If we divide the available income by the amount of the widgets, $52,496 over $1.30, we see that we can now buy 40,381 widgets under the fair tax versus only 39,831 under the present income tax. This results in a lower effective tax rate of 19.3% with a new statutory rate of 23%. So, the fair tax wins out well in this example as it would in most others as well. In fact, the better results will occur in the lower and middle income brackets for most average family sizes and living conditions. The important point to keep in mind when comparing the current system against the fair tax is that the current system will, in almost all cases, impose some federal taxing from the payroll tax, even though no income taxes were paid. We look at slide 21, Family Income and Tax Distribution. To capture the full benefit of the current system, may also require extensive knowledge of the code or paying someone else to provide their advertised expertise to achieve a favorable tax filing. In such cases, time and money is expended for an absolute penalty system, and the subsequent stress and concern of a potential audit furthers the cost Americans pay for an inefficient and absolutely unnecessary tax collection system. The fair tax, on the other hand, imposes no federal tax, excepting excise taxes as with the current system, until the taxpayer has surpassed their annual consumption allowance, and even then, the amount of tax to be paid can be controlled through thrift purchases of used items or otherwise limited individual consumption. There is no additional expenditures in time, money, and stress to comply individually with the fair tax beyond the registering with the state administering authorities each year to receive the rebate or prebate. All in all, a much better system and a more cost-effective system, particularly for the lower and middle wage earners who suffer such high percentage losses to income and payroll taxes under the current code. For a calculation of your taxes, now versus what can you expect from the fair tax, go to the fair tax calculator at www.fairtax.org. Taxing the international tourist economy. One of the greatest advantages to the fair tax is how it captures revenues from economic activities in the country that were previously not assessed. In 2008, the United States was the host to a record number of more than 58 million international visitors who spent an estimated $112 billion while in this country. The contribution of those visitors to our general and Social Security revenues under the fair tax could have been in excess of $25 billion. Taxing underground economies. Underground economies include both legal, shadow economy, and illegal activities wherein money exchanged for goods or services between parties constitutes a taxable income that is not reported and taxed. Drugs and prostitution as examples. It is estimated that underground economies represent between 1 and 2 trillion in monetary exchanges, which amounts to federal revenue losses in the hundreds of billions of dollars each year. The fair tax will more efficiently and effectively capture tax revenues from underground economies when money from such exchanges is used to purchase legal goods and services from registered sellers. Reversing the business and money flow. Removing corporate taxes, withholding taxes, and the tremendous measures in time and money expended trying to comply with the current tax code will help to lure businesses back to America or encourage foreign companies to establish businesses in this country for the first time. American-built products destined for foreign sales without embedded taxes will have a greater opportunity to provide more competitive pricing in overseas markets. The elimination of income taxes on savings and investments will lure the 11 to 13 trillion in offshore financial centers back to America, where it will be deposited or invested in U.S. financial institutions. This will increase the money available for loans, decrease the interest rates, and provide money for corporate capital improvements, thus jobs. The elimination of gift and estate taxes and the recognition of America's outstanding system of laws will add immeasurably to the incentive to invest or reinvest in America. Government taxes. Under the fair tax, governments will pay their share of the tax depending upon what service the government entity performs and at which level, federal or state, including municipal governments within the state. Government agencies will be considered to be of two categories, those that are enterprises and those that are not. All government agencies, federal and state, that are not an enterprise will pay the sales tax on all goods and services purchased the same as a private consumer. Government enterprises are those agencies within any federal or state government that provide a product or service for which the consumer directly pays for such product or service. A good example of a federal enterprise is the United States Post Office, which charges the public for products and services, stamps, and mail delivery services as examples. A municipal enterprise may be the utilities some state-level governments provide to their citizens, for which the public pays directly for the product and service. In the case of all government enterprises, they will charge the sales tax on their offered goods and services the same as any commercial business, which is very appropriate given they compete with commercial enterprises as well. Government enterprises will then be eligible for business-to-business purchases without paying the sales tax on goods and services purchased by them for use within the enterprise or for resale. Also, and a very important point, any subsidy given to a government enterprise by the government will be assessed a 23% tax on the subsidy, which can occur, for example, when the federal government subsidizes Amtrak to keep it in business.